How did one of America's most profitable airlines go from a symbol of ultra-cheap flying to fighting for its life? This is the story of Spirit Airlines and its billion-dollar mistake. For years, Spirit was the airline you loved to hate, but flew anyway. Cramped seats, endless fees, and no frills, but also rock-bottom prices that kept planes packed and profits soaring. But then, a series of strategic blunders, regulatory battles, and crushing debt pushed the airline to the brink of collapse. This is how a company that seemed untouchable in the budget space ended up in a desperate struggle for survival. Spirit's rise began with a brutally simple idea. Strip air travel down to its absolute basics. Forget free bags, free snacks, or extra legroom unless you paid for it. The airline offered some of the lowest base fares in the industry and then made its real money from a fee for your carry-on bag, a fee for your checked luggage, a fee to choose your seat, a fee for priority boarding, even a fee to print your boarding pass at the airport. Passengers joked about it, but the model worked like a charm. Spirit filled its planes with price-sensitive travelers who just wanted the cheapest ticket possible, and the airline became famous for profit margins that legacy carriers could only dream of. Its brand was controversial, sure, but financially, Spirit was a quiet powerhouse in the American aviation industry. But then, the first cracks started to appear as the world around Spirit began to change. Other airlines watched its success, studied its playbook, and launched their own basic economy options. The difference? They offered these cheap seats on bigger, more comfortable planes, often with better on-time performance and a less hostile attitude toward fees. Suddenly, Spirit wasn't the only game in town for cheap flights. At the same time, its own costs started to climb. Fuel prices went up, labor contracts became more expensive, and maintaining and expanding its fleet cost more than ever. The old formula of pack the plane, charge for everything, and stay the cheapest was becoming much harder to maintain. Spirit was at a crossroads. Should it double down on being the absolute bare-bones carrier, or should it try to move slightly upmarket to attract a wider audience? The company gradually chose the second option, and that decision became the heart of its billion-dollar mistake. Spirit launched an aggressive growth plan, adding new routes in highly competitive markets and trying to win over customers who expected a little more comfort. It introduced its roomier big front seats, experimented with more flexible ticket policies, and tried to polish its public image. On paper, this sounded smart, captured more customers while keeping the low-cost engine running, but in practice, it put the airline in a dangerous no-man's land. It was no longer consistently the cheapest option, but it was still a far cry from a full-service experience. For many travelers, this erased the one single reason they were willing to tolerate the airline's infamous discomfort and fee structure in the first place. As the airline grew, so did the financial pressure. Rapid expansion meant more planes, more crew, more debt, and more exposure to operational meltdowns. Every weather delay, maintenance issue, or staffing shortage hit the airline harder because its network was stretched thin and tightly scheduled. When the pandemic first collapsed travel demand and then sent it surging back chaotically, Spirit was especially vulnerable. The airline struggled with massive cancellations and terrible reliability at the exact moment when passengers were less willing to accept chaos, even for a cheap fare. Its reputation, never a strong point, deteriorated even further. Behind the scenes, the balance sheet was bleeding. Years of thin or negative profits, rising interest costs, and huge capital commitments left Spirit with very little room to maneuver. It became clear that the airline needed either a massive turnaround or a strategic partner to save it. That partner appeared in the form of JetBlue, which offered billions of dollars to buy Spirit. The deal promised a payday for shareholders, a larger network for employees, and a quick path for JetBlue to become a bigger competitor against the legacy carriers. But regulators saw something completely different. The government argued that combining JetBlue and Spirit would remove a key source of ultra-low fare competition in the United States. Even if people disliked flying Spirit, its presence on a route often forced other airlines to keep their own prices lower. Eliminating that downward pressure, regulators claimed, would hurt consumers in the long run. After a long legal battle, The merger was officially blocked by a federal judge. Eventually, the deal was terminated, leaving Spirit with a damaged balance sheet, massive legal bills, and no lifeline. What had seemed like a brilliant exit strategy had become a dead end. Facing intense competition from both legacy airlines and newer, scrappier, low-cost rivals, and it no longer had a clear identity. It had spent years chasing growth and trying to become slightly more premium, but customer perception never caught up. To budget travelers, Spirit was no longer the obvious cheapest choice, and to comfort seekers, it was still just the airline of cramped seats and endless fees. This strategic limbo led to declining ticket prices and weaker performance on its most important routes. Operationally, Spirit also struggled with a business model that left no margin for error. Ultra-low-cost carriers rely on squeezing the maximum flying time out of every single aircraft and crew member. When operations are smooth, this is incredibly efficient. But the moment disruptions become frequent, whether from weather, air traffic congestion, or staffing shortages, the entire system strains. Delays cascade through the schedule, compensation costs skyrocket, and customer frustration explodes online. Spirit's reputation for cancellations and poor reliability made it harder to attract new customers willing to pay higher fares, locking the airline into a vicious cycle of discounting just to keep its planes full. Financial distress quickly followed the strategic and operational problems. The airline reported loss after loss and began raising serious questions about its ability to stay in business. It had to renegotiate its debt, shrink its fleet and route network, and finally admit what it had avoided for years. The growth-at-all-cost strategy was unsustainable. The failure of the JetBlue merger meant there was no buyer to absorb these mistakes. Spirit had to confront them head-on, or risk disappearing from the skies entirely. The billion-dollar mistake of Spirit Airlines, then, wasn't one single event, but a chain of miscalculations. The airline tried to get bigger before it was stronger. It blurred its original ultra-low-cost identity without building a compelling new one. It gambled everything on a massive, controversial merger instead of fixing its own underlying problems first, and it completely underestimated how quickly competitors and regulators could block the escape routes it was counting on. The cost was measured in billions of dollars of lost value and the very real possibility that the airline might not survive. Yet, the story of Spirit is more than just a cautionary tale. It reveals the razor-thin line that low-cost airlines have to walk: stay painfully lean and unpopular, but profitable. For Spirit, its rise came from absolute clarity about who it was and who it served. Its fall came when that clarity was replaced by aggressive growth targets, branding experiments, and the desperate hope that a merger would fix its fundamental problems, whether the airline ultimately recovers or vanishes. Its journey stands as a powerful lesson in how a winning business model can be undone by the wrong kind of ambition. Thanks for watching, and if you enjoyed this story, don't forget to like and subscribe for more deep dives into the world of business.